Do you know how much your investment advisor is actually costing you? I mean the actual dollar impact their fees are having on your long-term goals. We're going to explore the fee structures of some of the largest advisory firms in the world and actually quantify the impact those fees will have on your bottom line so that you can be fully informed when it comes to your financial future. Coming up. Hey there. If this is your first time here, my name is Steven Spicer, and it's my goal to help you invest smarter. There are too many people not hitting their long-term financial goals, and so many more unknowingly on that same path. I'm going to remedy that as best I can. I hope you'll join me for the ride by hitting that subscribe button and the little notification bell. Thanks. Welcome aboard. I still remember the day when I finally decided that I was going to buckle down and really dive deep into the investment options I was recommending to my clients. That's right, I'd been working for several years by that point for one of the largest financial planning firms in the nation and recommending solutions that, if I'm being honest with myself and you, I didn't fully understand. Yet at the same time, I'm pretty sure I understood them better than like 95%, probably more, of the field force that was around me. I mean, I was one of the go-tos for our region, one of the investment guys. After getting my CFP, Certified Financial Planner designation, as quickly as I possibly could so that I could finally have access to my firm's investment options, I eagerly burst onto the investment scene, earning the MDRT, Million Dollar Round Table, acknowledgement for investment performance that year. And that's awarded to the top 1% of the industry. This was the reason I had gotten into the financial planning world. Investments fascinate me. I had mastered the language from our home office sales representative. You see, our specialty investment vehicles were pretty complex. There were managers on the individual fund level who were constantly researching the best positions to hold. But then we also had experts at our home office who were reviewing the overlap of the underlying fund holdings. And then we even boasted some additional oversight from the highest level of analysts at Morningstar. It all sounded very sophisticated. It was much more than that. That's a nutshell summary. It, if nothing else, created a compelling enough excuse for rather high fees. For smaller accounts, the total fees would sometimes be more than 2.5%. I had become a pro at explaining them away. It seemed like that was my job. You'd probably be surprised by how few people even batted an eye. Now, please don't get me wrong. It wasn't that I was lying to people. I was just doing what I was told. I was listening to people who had decades more experience than I did. I was in my early 20s at the time, who I felt were smarter in this area than I was, who I trusted to direct me to the best solutions for my clients. That's what started to eat away at me, though. Something wasn't right. And I think I had been putting off this deep dive into our solutions because I was afraid of what I might find. But I couldn't shirk my fiduciary responsibility to my clients any longer, so I dug. I spent days seeking answers. In short, I discovered that the primary solution our firm was pushing consistently underperformed the market. It had been around for more than a decade, since before 2000, and the actual annualized return for each of our models was quite a bit lower than their respective benchmarks, to the tune of 1 or 2 percentage points. And we've already discussed in a previous video how much of an impact that can make. And by the way, I haven't been there for a long time, so I have no idea how they're performing today. Maybe they're doing better today, maybe they dug out of that hole, maybe they've started something new, I have no idea. But in that moment, they were underperforming, all of them. And maybe there was an entire team of experts monitoring these models, and they needed to be paid. But if that monitoring is not generating a superior performance, ever, not even for one of the models, then why? If our investment solutions were outperforming by more than the fees that the firm was charging over the long run, then the value proposition might make sense. But they weren't. They consistently underperformed, costing my clients money. And they were expensive, losing them even more money. It wasn't long after this initial period of self-discovery that I left that firm in search of something better, ideally the best possible solutions for my clients. And that company that I was working for, Northwestern Mutual, is not a small player in the investment industry. Their investment services arm is, in fact, the 5th largest independent broker-dealer by revenue, raking in more than $1 billion in commissions and fees on those complex investment strategies pushed by their massive field force. This isn't, however, some isolated case. The list of highly regarded firms charging significant fees to manage investment dollars is upsetting. Edward Jones, with its 1.1 trillion with a T, of assets under management, has its field force charging an ongoing 1.35% management fee for a client's first $250,000, plus other smaller hidden fees and the underlying fund fees. More on those in another video. JP Morgan charges a 1.45% advisory fee, Merrill Lynch 2%, Wells Fargo 2%, Morgan Stanley 2.5%, UBS 2.5%. One of the worst culprits of this high fee madness is Ameriprise Financial. With $500 billion of assets under management, Ameriprise gets away with charging a 3% advisory fee on smaller accounts. And that's just the advisory fee. Add in the other smaller hidden fees and underlying funds fees, and some clients could end up paying 3.5% or more each year in fees. It's no surprise to see Ameriprise consistently at the top of the list of independent broker-dealers by revenue, cashing in almost $4 billion in fee and commission revenue in 2018, almost twice as much as the next company on that list with a similar business model, despite managing significantly less than some other firms. All the firms I've listed thus far are what are called broker-dealers. But what about the fees charged by registered investment advisors, RIAs? Those firms are actually held to a fiduciary standard, meaning they are legally supposed to be acting in your best interest. So in theory, you'd think their fees might be more agreeable, wouldn't you? As it turns out, they're not much better in the fee department. Work your way through Barron's 2019 list of top RIAs, and you'll discover more high fees eating away at investors' returns. By far the largest RIA in the world, with its more than 1.2 million clients, Edelman Financial Engines, charges its smallest, by account size, clients a 1.75% annual fee. The Tony Robbins promoted Creative Planning takes second spot on that list with its 1.2% fee, followed by Private Advisor Group's 2% annual fee on accounts under $500,000. Next, you'll find Mariner Wealth Advisors with its 2.5% annual fee for smaller accounts. You get the idea. There are a lot of people out there paying a lot of money in fees year in and year out. The big question then is, are they worth it? Now, there are two sides to this equation. In a future video, we can evaluate the effectiveness and value of the various strategies these firms employ. This video, however, is the perfect place to evaluate and develop your understanding of that true cost. Because it's not just 1.5% or 2.5% or any percentage. That's meaningless when it comes to your financial aspirations. Percentages are too disconnected from what your goal actually is when you're enlisting the help of a professional. We need to evaluate this cost in terms of dollars. Is that cost worth the value that they're bringing? That's the question. So the average annual advisory fee from 2017 through 2019 for an investment account with $1 million was 1.02%. Larger accounts averaged less, obviously, and smaller accounts averaged more. Sometimes, often, much more, depending on how much smaller. For this true cost exercise, and to understand the impact these fees have on what your reasonable expectation for average account growth in the market should be, let's round down to an even 1%. After accounting for this average advisory fee, remember, this fee is usually much higher for smaller account sizes, i.e. sub $1 million, the actual realized return that we discussed in our last video drops from the S&P 500's geometric average of 10.2% down to 9.1%. Remember from our last video that $100 invested in 1926 that would have been projected to grow to $4.6 million with the 12.1% assumption, but then in reality turned out to be less than 1 million. Well, when you add in this 1% advisory fee, it's more like 350,000. From 4.6 million to 350,000. That's less than 8% of the expectation. The practical implication for you, your account value would now only be 76% of its projected value after 10 years, 58% of its projected value after 20 years, and only 44% of its projected value after 30 years. So now, even if everything goes according to plan, your $10,000 investment after 30 years has only grown to $136,000 when you were projecting and planning for $308,000. In his 1996 New York Times bestseller, The Truth About Money, Ric Edelman of Edelman Financial Engines uses multiple convincing hypotheticals to encourage readers to invest in the stock market. Here's one. Although the average stock fund earned 14.5% over the last 10 years, we'll say that yours performed below average, earning only 12% a year. At that rate, your $5,000 will grow to $99,000. Let's check in with my made-up 42-year-old friend Brody. Reading this advice in 1996, he was convinced by Mr. Edelman's case for stock market investing and excited by his conservative 12% expectation. He eagerly handed his $80,000 nest egg over to Edelman's firm, needing that sum to grow to $1 million by the end of 2019, when Brody would be 65 and ready to retire. An $80,000 investment at 12% per year for 23 years, 1997 through 2019, would grow to $1,084,000. The reality for my poor friend was far from that conservative $1 million projection. From the beginning of 1997 through the end of 2019, a remarkable year for the market, by the way, the market realized a simple average of 10.3%. A far cry from that 14% seed that Edelman planted in Brody's and millions of others' mind. His actual return, remember the difference explained in this video, was only 8.6%, leaving him with less than half of his original projection. That's right, that real 8.6% would have left him with $538,000 instead of the more than $1 million that projected 12% should have gotten him. But we're not done here. Add in Edelman's advisory fee of 1.75% for an account of that size. That's his current rate, by the way. It used to be higher. And the effective annualized return drops to 6.7%, resulting in an account balance of $359,000, 67% less than what Brody was expecting. That $5,000 Edelman was talking about didn't grow to $99,000. When you apply the real geometric average and account for the advisory fee, it only grew to $25,000 over those 25 years. Edelman Financial Engines is not even the worst offender here, at least from the fee perspective, it's not. But from the 12% claim perspective, Ric Edelman is definitely on the list of worst offenders. The title of most outrageous fees that so many people are talked into paying should probably go to the aforementioned Ameriprise Financial, with its roughly $500 billion of assets under management and 3% advisory fee. That 3% fee takes your since 1926 number down to $52,000. 1% of your original expectation. Your 10-year return would be 62% of its projected value. 20-year return would be 39% of its projected value. And your 30-year return would be 24% of its projected value. That $10,000 is only $74,000 now after 30 years, instead of the $308,000 you were originally projecting and planning for. They'd have to be providing some major value over there for this to be worth it. And I can't imagine some fancy computer software and friendly customer service would do the trick. I'm thinking that for it to be worth all of that, It'd have to be more like maid service, childcare, a private car when you need it, the works. Now, to be fair, with this video alone, we don't have enough data here yet to determine if these fees are actually worth the impact or not. It is hard to imagine that being the case for some of them, but in our honest pursuit of truth, we'd have to consider both sides of the equation, including what you actually get for all this expense. In this video, we're just looking at the bottom line impact of these fees on your long-term plans. In a future video, we'll explore the other side, what firms are actually offering, and if some are worth their elevated fees, or if they've just realized that it's easy for people to brush over all these relatively small-looking percentages. Regardless, this exploration of the impact any fee has on our real returns demonstrates that we need to manage our expectations even more. Now, once you've come to terms with everything we just went over in this video, hold on tight, because we still got to knock down those expectations just a little bit more. We'll do that in the next video. So hit subscribe and the notification bell so that you don't miss it. And if you want more access to some of the behind-the-scenes research we're doing to help you better understand and overcome financial issues like this, you should go poke around our private community at community.spicercapital.com. I can't wait to see you there. I wish you all the best.